Welcome to the Power Investing Weekly Sector Review. We're going to start right here as we went over in the macro review, which we posted yesterday afternoon, that the defensive sectors are definitely what's still leading. We have consumer staples on top. When we look at our market weighted sector, this is all on the macro page. Consumer staples on top, real estate next, and then utilities, and then healthcare. Now, healthcare has some good growth in it, but again, these others are very defensive, staying up top here. Going down next to the equal weight sectors, we can see as well consumer staples, real estate, utilities, all still on top from the equal weight standpoint as well. Healthcare next, materials, technology about in the middle of this one after being a little bit lower on the large cap version. And then when we go to the small cap, we can see that consumer staples is still on top. However, information technology takes over the second spot here. And then utilities, materials, industrials, health, real estate falls all the way down here towards the bottom, and healthcare both on the small cap side. So it looks like both of these are still favoring the mid to high side, which we'll see in a minute definitely makes sense. So that just gives you a quick review or run by again of what we went over in the macro view. So let's move over to our universe page and start looking at kind of where things are. Oops, left that right in the middle on the sector scenario. We're going to skip right down here because, again, we covered all the macro stuff on the last video. It's right at 10 minutes. You can take a look at that on our PowerPoints page. But with the equal weight sectors, you can see utilities are on top instead of consumer staples. Consumer staples are second, materials third, real estate fourth. Okay, so from a equal weight standpoint and all the stocks that we follow, real estate's not quite as far as it is on the others. It's something we want to focus on because most of the real estate ETFs look like they've already moved pretty strongly and broken out a good while back. So if you want to go into real estate at this point, I think you either have to wait for a pullback in some of these larger names, or you're going to have to dig a little deeper and find some of the names that are underneath the surface there. Industrials right in the middle, information technology on the bottom half, communication services stays on the bottom, as we talked about in our video last week. And then we go into our equal weight sectors. Okay, we're going to come right back to this particular chart, but what I'm going to do is I'm going to jump over to the Google spreadsheets that we have that give a little bit more of an overview of kind of where some of these breadth measures are for all of the subsectors and sectors. So we can look at this big overview before we start digging down into some of them. In the first one, we can see the universe up top has 76% above the 20-day moving average, 51% above the 50, and 55% above the 200. Most all have over 60%. As they're highlighted green, except for energy is right at 60, or over 65%, and then over 90% for consumer staples. So definitely one of the leaders there. From the 50-day moving average, consumer staples is the highest as well. But note financials from a 200-day moving average still at a 71%, which is pretty strong. Something that might be worth keeping an eye on to see if financials can start to perform a little better. But as we go down here, we can go through and see that in materials, you have 86%, 82, 85, 89. Very strong over there. Consumer discretionary has some real strong areas as well. It's just internet and direct marketing and apparel and luxury goods holding it back. And then you have a good bit of strength, of course, in staples and real estate, as we discussed. Utilities as well, other than the independent renewals, which is just now coming up. So this is a great thing to kind of glance at, again, from a visual, and we colorize based on whether you have strength or weakness in certain areas or just kind of neutral in the middle. We also want to flip real quick over to our short-term breadth indicator, which, again, this is better in extremes, either up or downsides. More so on the downside, though. Extreme upside can take a little more time to work off. But as we look at here, again, we have quite a few that have the percent making new 10-day highs in a zone that we have highlighted, which is over the 20% range, making new 10-day highs, especially off of extreme lows when we start seeing that early, which we did last week. This is not brand new or fresh to see these green areas. When they first pop up after being red for a while, it is definitely something we want to take note of. Now, as well, the percent above the 200-day or 20-day moving average we've already discussed. But very few making 10-day lows anywhere. We have a few, like 13% in telecom, one of the highest we see on this entire chart. So now we move back to our universe and we can kind of see the subsectors. Semiconductors remains on top, and then we have some of our defensive and consumer staples, utilities. Hardware and equipment hops up here in the top 10, which is kind of interesting at an 86. It's our highest in technology, one a lot of people wouldn't expect, but we have quite a bit in that area that seems to be working, which we'll take a glance at here in a bit. But when we search this in a few different ways, like see who performed for the week, we get a very different picture. Consumer discretionary, materials, some utilities, industrial, technology, that kind of stuff. A little more consumer discretionary up there than one might expect. And then also when we did the RS movers for the week, we start seeing consumer discretionary popping in up here towards the highs as well. Now, one thing I did to take a look at, and I put in, I'll put in the scenario is this right here, the equal weight sectors. If we look at who made the biggest moves over the last month, yes, you have some utilities and staples, but you have a couple consumer discretionaries jumping in here as well. Diversified consumer services, hotel and leisure, staples, food and staple retailing from consumer staples is still strong. Commercial REITs, healthcare, medical devices moving up more than 20 points over the last month, and another real estate. So again, still some defensive in here, healthcare services up here, but definitely some moves and some changes over the last month than what we had seen in the past. And some of these are still in reasonable levels, like healthcare services at 53, but yet moving up a decent amount. So we want to kind of take a look at some of these areas. I'm going to start with one of the stronger subsectors, which is consumer staples. And with the consumer staples, we see that on our RSI chart, it's already moved into a bull range. It's made a strong move off the lows, but from an equal weight standpoint, it's not as far broken out and has not broken out over the previous highs as it has here, as it has with the market weight ETFs. Again, this is one of the areas that a lot of the ETFs look pretty strong, like they've moved a good bit, as we can see right here with FSTA, the Fidelity weights already broke out a few weeks back and started moving pretty strongly. However, if it is something you still want to look at from ETF standpoint, the equal weight ETF, RHS, looks like it's a little closer to its breakout point, and it looks like it is right above that area on the weekly, moving higher RSI on both daily and weekly. So you might want to kind of take a look there as opposed to the market weighted, because a lot of those larger cap names have already moved pretty substantially over the recent time period. Now, when we look into them, it's a tale of three different areas. Food and staple retailing, which is the top ranked sector. Let me go back real quick. Sorry about that. We pull down here and look at the breadth, and it's certainly improving all across the sector here. And then we pull on down and see that the percent making new highs on all three of them are up strong and staying strong, and have been for a little bit longer. That last dip did almost nothing for this area as it remained really strong. And the rankings within it are food staple retailing, household and personal products, and food and beverage tobacco. We're going to look at them in this realm here in just a minute, but we are going to look at the ETFs real quick. I just made the comment that the large cap ETFs have already moved pretty well, and they have. But taking a look here inside this particular table and what's been moving in that kind of scenario, RHS, the equal weight chart, looked to me like a better chart as I just showed you. The Fidelity looks like it's already moved pretty strong, which is similar to the other large cap players. But inside the sector, food and staple retailing, is really the leader, and it broke out last week. Okay, from an equal weight standpoint, that's a pretty long sideways move that it's just now breaking out of. And if I pull it on down here like I should have, you can see its RSI has already moved into the bull range and is looking pretty strong, and its RS on both the 3-month and 6-month is already back up near the highs versus all the other subsectors. Breadth here is strong as well. And then we move on down to the comparative charts. We see them all here pretty much turning up, except for versus consumer staples itself. It's been leading against it for a while, but right now it looks like it's kind of moving sideways versus the overall sector. In the stock section, we'll cover a few of the stocks and some of the areas that I thought had some opportunity there. Now we move over to household and personal products, and you can see this one hasn't quite broke out yet. And it's right at these highs of the previous levels we've seen Okay, it had the little false breakout and then came way down, and now it's working its way back up on this RSI chart. Again, I got to get better about putting the whole chart in here so you can see the RSI and CFG down here bottomed out really well in late November and have been worked strong. Now, some being an equal weight, we could still have some strength here under the surface here. We're seeing 96% of them are above the 20-day moving average and 74% above the 200. So we have strength in most of the sector, but some of them have already moved pretty strong. So if we want to get down here and look at ones who have not moved strong enough, you want to go in here and kind of search through this area. Like I said, when we looked at this top, sorry for the quick movement, when we looked at this top, this relative strength has been building now for a month and ready to potentially break out in household products. And then, of course, your third and final in food, beverage, and tobacco, which is the area most pay the most attention to. Within the sector, you can see it's been the biggest laggard. Okay, so it has been the laggard. It has moved up into a bull range like the others at this point, but its chart still is well off the highs it made back in June of this year. So is this going to play catch up is something you can decide. It has a lot more holdings for you to take a look at and weed through. It's certainly moved on its different breadth measures, making a strong move over the last few weeks to a month, and looks like it can continue, but again, well off its highs that it was in back in June. And as you can see here, it's still not really the relative strength leader, especially not in the particular sector that it's looking at. So overall, if consumer staples stay strong, it may be an area that can continue to perform, but it is not the leading area. In here, you can still find some good gems. I'll show those in the stocks section or next video for stocks. Now, once we move from here, actually, let's look at one that was in the food and staples retailing was BJ's. Again, we can see right here, this is still in an RSI bull range, made a positive reversal there, and now moving back higher on the daily, and the weekly held a strong bull range as it pulled back in flagging action. You know, a move over this 68-ish area gets this one moving again. So that's all we're going to go through for stocks, but let's move over to communication services. This is like the dead sector. And we're not going to spend a lot of time in here, but I wanted to basically just make a quick point that this one is dead as a sector, but when you move down to the subsector, media and entertainment subsector, it made a higher high here and is flagging across above that little breakout level. So this may be one to hop on the website, look a little deeper on. Breadth is certainly improving on the short-term basis and still needs work on the mid and long term. So this is one where if you want to buy pullbacks in something that might have been beat up last year but start showing some strength this year, then come down and take a look in some of these particular areas. But before I end the video, I want to flip over to technology. And in technology, there are 4 subsectors. Semiconductors is our leader, hardware and equipment, IT services, and software. Hardware and equipment just doesn't get enough attention, and so I thought we might take a quick look at it here from a sector standpoint. You can see right here that as it's doing a W right here at the highs and flagging across the last couple of days, this held the bull range during the entire pullback, which is something most sectors or subsectors across the entire universe did not do, and now looks like it has the potential to break out and move higher. Now we pull down here in the breadth remains pretty strong, not way overbought on any of the measures, but definitely up in the higher realms and workable with the summation turning higher and crossing as well. So moving down here into the relative comparatives, it's one sector that continues against small caps to be strong and is moving up the last week or so against all the other measures that it is put against. Now, when we come down here and look at the holdings, this is one again. We'll take a little bit more look in the stock video. So that is semiconductors. Sorry. Oh, terrible. The hardware sector is right here, and basically it is right up against the highs and a bigger breakout level. Semiconductors had moved ahead. I explained it all as hardware. I apologize. real quick to go through this one. It's been in a much longer sideways move. That's why semiconductors are still leading it. It's just now breaking back above the bull range again. It's been pretty volatile back and forth as it's moved sideways. So if we can move over these highs in this peak area after flagging here, I think hardware could end up being one that kind of picks up if inside the technology zone. Again, it has 81% above the 20-day, 68 and 61. So not as strong as semiconductors, but continuing to move up. And again, doesn't get nearly the attention from a relative strength standpoint. It's been strong against technology during this whole pullback, and it's also strong versus the universe as a whole. And then some of the leaders in here, Sienna, EXTR, RDWR, PAY, things that we don't think about every day. LITE, good potential. Some of these have already moved since these are up at the highs. But if you go in here and look at the RS movers in general, you can see that there are some good plays to potentially pull out. So that's all we have for this week's video. Good luck out there. I'll be putting some more stuff out throughout the week, so we'll catch up on some areas that we didn't cover today. Have a good day.